Real estate sector in India is expected to reach a market size of $1 trillion by 2030. And that explains global institutional investors' elevated appetite for exposure to Indian real estate. For more than a decade now, private equity majors like Blackstone, Brookfield, GIC, CPPIB, Warburg Pincus, you name, and all of them have been investing billions of dollars in Indian real estate. Now, as a retail investor, you may not be able to deploy huge capital to get control of big office parks and projects. However, there is a legitimate route available for you to participate in this growth story. Hi, I'm Kailash Babar from Economic Times. In this video, we'll discuss about how you can also be part of this growth story by investing through Real Estate Investment Trust or REITs. What are REITs? REITs or Real Estate Investment Trusts, as they are known, are entities that own, finance, and operate income-producing properties to generate income. These entities manage the portfolio of high-value real estate properties. For instance, they lease properties and collect rent therefrom. The rent collected is then distributed among shareholders as income and dividends after taking care of major expenses. So if you're investing in mutual funds, let me tell you, this concept is very similar to mutual funds. Key difference, however, is that these trusts own, operate, and manage a portfolio of income-generating properties for regular returns as against a mutual fund, which is usually an investor in the business run by some other company. Typically, REITs offer investors an opportunity to possess high-priced real estate and enable them to earn dividend income to boost their capital eventually. This way, investors can utilize the opportunity to appreciate their capital through the asset's price appreciation and generate income through regular dividends and interest at the same time. So, investing in REITs will allow investors to invest in a pool of real estate properties without having to own the physical property itself. REITs will invest on your behalf in revenue yielding assets, primarily large commercial spaces and establishments, and work as a pass-through entity for investors looking to purchase into these specific portfolio of instruments. So, what are the rules that REITs will have to follow with respect to their own investments? A minimum of 90% of net distributable cash flow, which is the cash flow available with you as surplus after taking care of operations, maintenance, also depreciation of the properties, and those heads have been taken care of. So whatever surplus available, 90% of that needs to be distributed to unit holders or you shareholders. At least 80% of the value of the REIT assets need to be invested in completed or rent or income generating assets. But this needs to be done with a lock-in period of 3 years from purchase date. Balance 20% they're allowed to invest in under construction properties, again with a lock-in period of 3 years after completion, and completed but non-rent generating properties with a lock-in period of 3 years. That remains same from the date of purchase. They can also invest in listed or unlisted debt of companies or body corporates in real estate sector, other than investing in debt of their holding companies or special purpose vehicles. They can also invest in mortgage-backed securities, government securities, and also equity shares of listed companies in India. But these companies need to be generating at least 75% of their operating income from real estate activities. Individual investor, the dividend you receive enjoys the tax exemption treatment. They also enjoy transparency and liquidity as REITs are listed on stock exchanges, unlike fractional ownership of vehicles. Any information or performance of the REIT, its price or trading can be accessed online. It can also offer easy liquidity for entry and exit anytime during the trading hours in line with shares. As you're aware, physical real estate that you may own and wish to liquidate takes time and is not as liquid at times. REITs offer you the benefit of owning a property without investing huge sum, along with the ease of liquidity that you can exit anytime. Also, apart from this, you can enjoy diversification. Investors who are looking to add income producing assets in their portfolio without investing huge sum can do so with REITs. It can be a part of versatile of a well-diversified portfolio among, say, stocks, mutual funds, commodities, precious metals, and others. It also offers you flexibility as a small and average investor, but he can invest a small amount in a REIT, which in turn will collect this amount on behalf of these retail investors and buy commercial assets, which will provide them superior returns, which are usually beyond his or her reach due to the limitation of availability of capital. So initially, SEBI had mandated that anybody who is investing at least 2 lakh rupees can invest in this product. Later on, this was lowered to 50,000 rupees. And now, recently, SEBI has lowered it further in line with equity shares. So if you can buy one share of any company, you can buy one unit of REIT as well. So you're allowed to invest even the minimum amount here. There is no restriction on any threshold. So it's very easy. The way you buy equity shares, you go to the broker site, or you punch in your order and you buy any share. This is the way REITs are also bought and sold. They are also listed on stock exchange, like I mentioned earlier, and you get pricing related, trading related, all details available on stock exchanges, and you can buy REITs same way, the way you buy equity shares. So for REITs, the investment strategy should be in line with what you do with your equity. Any money that you have in surplus can go into this. Anything that you need in terms of emergency or urgency, I wouldn't recommend, or I don't think anybody would recommend putting that in this kind of instruments, because at times when the markets, it all depends on the market dynamics. For any investment or for any asset class, the longer you hold, better are your returns. And in REITs also, that's why we have long-term capital gains tax being made available to you with a holding period of 3 years, not in line with equity shares, where you hold equity shares for 1 year. Here you are expected to hold your REIT units for 3 years to get that benefit. So even the regulators expect you to participate in this asset class for longer duration, so that you can get better returns and stable returns. So globally, REITs have become an increasingly popular vehicle to own real estate ever since its debut more than, say, 60 years ago. And India has joined this club in 2019, like I mentioned, in April 2019, when Blackstone-backed Embassy Office Park REIT got listed. That was the first REIT to be listed in India. In line with the global experience, this can also be replicated for retail malls, hotels, and most importantly, rental housing, which is coming up now, that can help resolve the housing deficit in India with institutional investors pumping in funds to build such rental projects. So for now, we only can, the REITs that we have in India that are listed, they invest only in office properties. And going forward, we'll have more asset classes also included in that. In India, the process, which started in 2007, like I mentioned, with the SEBI introducing draft regulation to govern REITs. SEBI notified these regulations in 2014, and it became a reality in April 2019, when the first REIT debuted on the market. Since then, we have two more REITs that have got listed on stock exchanges, including Kailash Babar and Blackstone's Mindspace Business Park REIT and Brookfield India Real Estate Trust. And all three have been performing well on both the counts of dividend distribution and capital appreciation. So I hope this video has helped you get an insight into REITs, basics about REIT and how it functions and the tax treatment. Hope you are able to make an informed decision if you are planning to invest in this new asset class, REITs. If you're looking for stable returns without investing huge sum of money that usually is required to invest in real estate, to make an investment.